I think it's important we get familiar with the fact that all investment strategies have their drawbacks, their pitfalls, and of course, their disadvantages. And dividend investing is not an exception. And in this particular video, I want to consider the 10 disadvantages or risk attached to dividend investing. Number one, limited growth potentials. Dividend stocks have this tendency to have a stunted growth. Their growth potentials are somewhat limited because the fund that will have been used to fund growth and expansion, is paid out to investors in form of dividends. And so that particular sacrifice of giving out funds to investors in form of dividends instead of plowing back to the company to sponsor to encourage growth in the company is paid out, and by so doing, you discover that the company concerned will not grow as expected compared to other companies in the market. Number two, tax implication. We need to understand the fact that dividend income, are taxed at a higher rate compared to capital growth tax. Capital growth tax is somewhat lower when you compare it to what is obtainable in the case of dividend income. They are taxed at a higher rate. And by so doing, you discover that the expected income stream isn't as much as what is obtainable, again, because of this level of taxation. Number three, dividend cuts. Sometimes when companies don't do very well, when they encounter hard times, difficult times, financial crisis, they tend to cut down, their level of dividend payouts, and that particular cut will affect the income stream of individuals, of investors that invest in dividend stocks. Certainly, it will then go a long way in reducing, what they were expecting to come in regularly as dividends, and these particular dividends may not be guaranteed because of what the company is facing at that particular point in time. Number four, market volatility. The markets, we all know, is volatile most of the times, and this volatility do affect dividend-paying stocks, do not at a rate. It affects other stocks in the market, but all the same, our dividend-paying stocks are not immune from market volatility. And so the market is volatile, and if you are concentrated on dividend-paying stocks, it will certainly affect the amount you are going to get at the end of the day as dividends. Number five, inflation risk. Inflation is something we cannot run away from. It's a phenomenon that is always ever present in the economy. And so we discover that sometimes, the amount paid out to investors as dividends may not outpace inflation. And as a result, you discover that the disposable income of investors, is curtailed because, inflation must have had a negative impact in the rate of dividends, paid out to investor. It will no longer hold the required purchasing power as is expected to. Number six, overemphasis, on income. Dividend investors tend to overemphasize income. They want to get this income by all means. And so once income is overemphasized, you discover that other important aspect of the stock, is underrated, is neglected, like fundamentals, like, its position in the market, like its financial strength, and many other factors are underrated because the investor is so much keen about, getting paid a regular dividends, at the end of the dividends, at the end of the expected period, which ought not to be so. In as much as dividends is good, we should not do that. We should not overemphasize its importance and then neglect other parts of the market, other parts of a company that is of great importance when it comes to, valuing the strength of a company. Number seven, opportunity cost. when we buy stocks in a given company, it might be a dividend paying company. We are doing that. We are incurring an opportunity cost because that particular fund will have been invested somewhere else, maybe in a high growth company. We might be, we may be able to get a better yield or a better return. And so when we invest in a dividend paying stock, we need to understand that we are doing that with an opportunity cost in mind, with an opportunity cost, at heart. And we should not, just go ahead because we want to obtain dividend, just, miss out of growing opportunities, out of value opportunity because you just want to get that particular income flow. No, let's tend to moderate everything. And it will go a long way in, affecting our result, our yield, our profit, our income positively. Number 8, sector concentration. We understand that some sectors, in the market tend to pay, higher dividends compared to other sectors. Sectors like utilities, like consumer staple, they tend to pay a higher level of dividends. And so, if you are bent on investing in those sectors because of the dividend payout, we may end up on over concentrating on a given sector and then incurring what is known as sector-related risk. If that sector is exposed to a certain level of risk, it will invariably affect our investments. And so we should avoid this particular concept, this idea of over-investing in a given sector because we want to get dividends that are inherent, in stocks in that particular sector. Please like this video, subscribe to my channel, and hit the notification button so that I can be encouraged to keep on bringing contents of this nature to you. Number 9, yield chasing. We don't just keep on chasing yield all around. The fact is that when we are so much involved or so much concentrated in on stocks that are yielding dividends, we may end up overlooking other aspects that are very, very important. And most of the times, or sometimes rather, you discover that companies that have a higher dividend payout, higher yield, may be having fundamental problems. It may not be a sign of the company doing fine, no, but rather it could reflect, difficulties underneath. And so we have to really investigate very well to see whether these companies that are paying, higher level of dividends, are sound financially. Are they having financial problems? Are they having, balance sheet issues? We need to investigate. Not just pursuing yield and nothing but yield. Let's also concentrate on other factors that will determine how strong the company we are investing in, is. Number 10, impact of interest rate. Interest rate, we all know, fluctuates, and the central bank, the apex bank may decide to fix, a particular rate of interest, and when that is done, you discover that, dividend-paying stocks or the dividend may not really, may not meet up with the current yield in other sectors, like in other asset class like bonds, and even in a typical savings account. And so whenever there's a change in interest rates, bonds and other investments tend to do better than dividend-paying stocks. And so let's consider this particular factor when it comes to dividend investing, because we should not overemphasize the issue of dividend above all other things in the markets. And it's advisable that we don't just put all our eggs in the same basket. Even it is good, it's advisable, it's recommended that we invest in dividend-paying stocks. Let's equally consider value investing alongside, consider growth investing alongside dividend investing, and equally incorporate momentum investing whenever our risk appetite permits. We should not just put all our eggs in dividend-paying stocks. In times of dividend cuts, our income might be affected negatively.